UK bonds are locked in a debt death spiral. That's what hedge fund manager Ray Dalio has said recently. In this video, we'll look at why that matters, what a debt death spiral means, but also more broadly whether the trillions in UK debt is sustainable and what could go wrong. Today's video is sponsored by Raise in the UK, the free, easy-to-use online savings marketplace. So let's dig into that concept of a death spiral. So here's Ray Dalio, and in an interview with the FT he said the following: when you get to the point that you have to borrow money to service the debt and interest rates are rising so that debt service payments rise, so you need to borrow more money to pay them, you're in what the markets call a death spiral. Now what people often do is a metaphor to explain what's going on there is imagine that you've got a credit card and you have to pay off the balance. But if you're borrowing more money to pay off the balance, then your debt just balloons and it becomes unsustainable. Now, there are many reasons why government debt is very different to personal debt. For a start, we can't print money, but that's the general idea. That's where the debt death spiral idea comes from. And countries do default on their debt, not often in developed markets, it has to be said, but in emerging markets it's quite a frequent event. For example, Argentina defaulted in 2001, 2022, Iceland defaulted in 2008 because of the global financial crisis, Greece defaulted in 2015 because of the sovereign debt crisis in Europe. And these defaults have huge negative consequences for the countries which default on their debt. Now, the UK hasn't defaulted on its debt since 1672. That's why UK gilts, UK government bonds, have that silver edge around them. It's to reflect their credit quality. There was a kind of technical default in the 1930s on World War I debt to America. But if you buy UK government bonds, it would be absolutely gobsmacking if the UK government were to default. So that's why what Ray Dalio said was so shocking. And let's briefly outline what the negative consequences for a country are when it does default on its debt. Often what follows is a recession. The reason why it defaulted in the first place was that it couldn't service its debt, which often goes hand in hand with weak growth. That tends to exacerbate the recession itself because the government can't spend to stimulate the economy. And of course, a recession means higher unemployment, so there's a fairly good chance you'd lose your job. And of course, if you have a free floating currency, that tends to devalue, and then we get pass-through inflation when it becomes more expensive to buy foreign goods. So in summary, don't default on your debt because it's really going to screw up the economy. So let's think about what it takes to make debt sustainable. Well, when we think about a country's debt, we usually compare it to the country's GDP, its gross domestic product. Because the key idea here is that as long as the debt isn't too large relative to what the country earns every year, that isn't a problem. And that's how we scale and measure how much debt a country's got. It's always relative to its GDP. So for the UK, our debt's about 3 trillion, it's just under, and I've rounded the numbers here for simplicity, and our GDP is about 3 trillion. So our debt to GDP, if these were the actual numbers, they're not, would be 100%. Now we can look at how the UK's debt to GDP has varied over time, and you can see that World War I, World War II cost huge amounts of money, which was funded largely by debt issuance. Taxes just weren't enough to fund the war effort. And of course that created a huge debt overhang for many years after those two world wars. Now if we look at the debt to GDP at its peak just after World War II, you can see that it reached about 250% for the UK. However, it then starts to fall, and that's because GDP grew more quickly than the debt which was outstanding. Now, there was a crisis more recently in 2008 with the global financial crisis, and there was a lot of debt issuance to try and stimulate the UK economy. Then we had the COVID pandemic in 2020, when again we decided to issue a lot of debt to pay for things like furlough programs, but also all of the other spending that went with that pandemic. And again, what we found is that we've got a big debt overhang as a result of that spending. Now, the Bank of England bought some of that debt, and when we consider the debt servicing cost, we actually subtract the holdings of the Bank of England. That's because any interest and coupon payments which the Bank of England makes is essentially the government paying itself. So we ignore that proportion of the debt which is held by the bank when it comes to the debt servicing costs. So we saw that the UK managed to get its debt to GDP to come down after World War II. So if we're to repeat that, then how can we do it? Well, like I said, you just have to grow more quickly than your debt does. So if, for example, our debt grows by 10%, but our GDP does as well, we're back to square one. The debt to GDP will remain at 100%. But if, say, GDP grew by 10%, that would be very high for the UK, and debt only grew by 5%, well, yes, then the debt to GDP would fall to 95%. So really that's the critical question. Can the UK grow its way out of this debt problem? Today's episode is sponsored by Raising UK, the no-fee online savings platform. If you're like me, you want to get the most from your savings. That's where Raising UK comes in, a free, easy-to-use marketplace that makes growing your money simple. Raising UK offers access to a huge variety of savings accounts from over 40 FSCS protected banks and building societies, all in one place. No need to hop between websites comparing rates, they've done the hard work for you. You can find everything from easy access accounts to notice accounts to fixed term bonds with competitive interest rates. And the best part? It's completely free to use. Once you've registered, you can manage all your savings from a single dashboard. Simple, streamlined, and super convenient. At Raising UK, all of the savings accounts offered are protected by the FSCS or European Deposit Guarantee Scheme, DGS. With FSCS protection, if you hold money with a UK authorised bank, building society or credit union that fails, you'll automatically be compensated up to £85,000 per eligible person per bank. What's more, for a limited time only, you can receive a £100 bonus when you register and fund your first savings account with a minimum of £10,000 using the code SAVINGS100. For more details, please visit the link below. So now let's look at the numbers for the UK to see whether UK debt is sustainable. Fortunately, the Office for Budget Responsibility, whose job it is to work out whether the debt is sustainable, has done this for us. And certainly based on their forecast, debt to GDP is very high. It's at around 97% currently, but it isn't forecast to rise significantly. In fact, it's expected to flatline and start to fall slightly. Now, one way to think of debt is kind of like water in a tank, where water is continually dribbling out of the tank as bonds mature. The amount of debt stock falls when that happens. And at the same time, the government is issuing new debt. So that's like pouring water into the top of the tank. So the amount of outstanding debt, the amount of water in the tank, depends on those two rates. How quickly are bonds maturing and how quickly is the government issuing? Now, the difference between those two numbers is called public sector net borrowing, and you can see how that's varied over time in this graph. Notice the spike for the pandemic spending period, and then it's fallen very sharply since then back to a kind of more normal level. And certainly according to the OBR's forecast, which itself was conditioned on the latest budget from the Labour Party, that public sector net borrowing is forecast to fall over time. Now, there are equations which govern how quickly the debt is going to increase, and essentially it's this idea of how much water you're adding to the tank. That's because you're spending more than you're earning in taxes, so that's called the primary balance. And then the other factors are how much you're having to pay to service the debt, so the rate that you can see here is relevant, and of course how quickly your economy is growing, because remember, that's how you reduce debt to GDP. So in order to get debt to GDP to fall, the primary balance, essentially what the government earns minus what it spends, has to exceed the number on the right-hand side. Now, both the primary balance and the debt is expressed as a ratio relative to GDP. I've simplified it for the sake of explanation. So let's put the numbers in based on the OBR's forecast for 24-25. And the primary balance is forecast to be minus 1.6%. So the government's going to spend more than it earns because it's trying to stimulate the economy. And it's front-loaded a lot of that stimulus spending in order to get growth going. The average rate that the UK pays on its government debt, according to the OBR, is 4.1%. Now that, of course, depends on the debt composition, how much is long-dated bonds, how much is short-dated bonds, because the yield curve has different interest rates at different parts of the yield curve. but that weighted average debt servicing cost is 4.1%, and GDP growth in nominal terms, that's without subtracting inflation, that's expected to be 3.5%. The debt to GDP ratio of the UK at that point in time is expected to be about 92%. Multiplied all together, and shock horror, it turns out UK debt is not sustainable. The primary balance is negative. We're spending about 2% more than we earn, and that minus 1.6% is less than 0.6. So is it all over? Are we entering a death spiral, as Ray Dalio has suggested? Well, maybe not. The point is that debt is a perpetual problem. There'll still be a Ramin making these videos in 20 years' time or 100 years' time. And the government has the ability to adapt what it does, both in terms of fiscal stimulus and the central bank's monetary stimulus. So there's a lot of wiggle room to get that debt down, as long as a government is determined to do that. Some governments just don't care, but what's very clear is that this Labour government cares very much about getting the debt to GDP back to sustainable amounts. So just before we panic, let's take a look at what happens at the end of the forecast period from the OBR, which is about 5 years in the future. So this is for the period from 2029 to 2030, and if we put those numbers in, what we can see is that we've actually got a primary balance which is in surplus. So the good news is at that point things are sustainable. And that's why when we look at that projection of debt to GDP, it does stabilise at the end of that forecast period. But there are lots of moving parts in the economy and a lot can go wrong. Now the OBR's done a nice little exercise where it looks at some particular variables, the most important ones, to see what could go wrong to wipe out that primary surplus at the end of its forecast period. Now if growth is not as high as expected, if nominal GDP growth was just 0.7 percentage points lower, that would wipe out the surplus. Now that's not much of a decrease, that's what the red blob is that you can see on the graph. A fairly small decrease in nominal GDP growth could be a problem. Another thing which would wipe out the current budget surplus, but which is much less likely, is if the government decides to cut taxes. Now just a 0.3 percentage point cut in the effective tax rate would wipe out the surplus. But this is unlikely to happen anyway. Now the one everyone's been focused on is what happens to interest rates. Now remember, this is not really under the government's control. If US yields increase, it usually drags up UK yields as well. And that's what caused a lot of consternation earlier this year. Now if effective interest rates were just 0.3 percentage points higher, that would also wipe out the budget surplus. And then finally, if inflation is higher, then that'll also wipe out the budget surplus. So if that was just 1.1 percentage points higher, that would make reducing the debt to GDP ratio very difficult. And if we just focus on the interest rate component, you can see how volatile yields are for UK gilts. Here I've shown the 5-year, 10-year and 20-year UK gilt yield. And this is for the period between 2023 and 2025. Now I've marked on there the OBR's forecast for the start of the period, and that's the lower yellow dashed line. And then at the end of the period, 29-30, it expects that rate to be higher. And then to wipe out the surplus, we just have to add 0.3 percentage points onto the end of the forecast period. But given the volatility of rates, you can actually see that that's quite likely. So all I'd say is don't panic if yields do blow out to that point. They are volatile and they often fall after spiking higher. And it's worth mentioning that the government asked the OBR to produce a new forecast in March of 2025. That's just 2 months away as I make this video, so we'll get updates on all of these developments. But let me end by talking about opportunities. Now when YouTubers or hedge fund managers come out with really shocking statements which are about doom and gloom, they get lots of clicks. But I'd argue that in this case, with the bond market in the UK, if you hear a story about gilt yields blowing up, then I think that's an opportunity. If you don't believe that the UK is going to default, I don't. It's very, very unlikely. Actually, I'll go further than that. I'd say it's very, very, very unlikely. Then you can lock in a yield at a high rate of interest for taking very little risk. If you hold the bonds to maturity, then you know what yield you're going to get between the time you buy the bond and when it matures. And that's exactly what pension crafters have been doing during this period of higher yield. But it's not just pension crafters. If you look at this story from CityWire, you can see that on many platforms, the best-selling instruments have been gilts over this period of gilt market volatility. So I hope that's helped you to understand how UK debt sustainability is calculated and what the OBR's forecasts are actually saying at the moment. But also that when there is a crisis in the gilt market, it can be an opportunity, unless you think that the UK government is about to default on its debt. Now don't forget our offer from the sponsor of today's video, Ramin UK. You can receive a £100 bonus when you register and fund your first savings account with a minimum of £10,000 using the code SAVINGS100. And if you want more details about that, please visit the link below. And, as always, thank you for listening.